Today, I'm going to break down why Microsoft is one of the top stocks in my dividend growth stock portfolio and explain what just happened in earnings that shot the stock up another 7%. My name is Zach, this is Dividend Data, and I've been sharing my investment journey here on YouTube for the past few years. I follow a dividend growth investing strategy where I invest in high-quality businesses that are growing over time that continually raise their dividend payments every year. Some of those are high yield, lower growth stocks, and then others are low yield, high growth big tech companies like Microsoft. And if we look at my dividend growth portfolio, over 21% of that account is in just Microsoft. And this is a core position I plan to continue building and holding for decades to come. I primarily built this position during fall 2022 when we had a tech sell-off. And so far, I have a 55% total return on the stock prior to it going up 7% after hours. However, I have been adding to my Microsoft position recently in early 2025. And the future of Microsoft's business and growth is actually more clear today than it was when I initially bought. But first, let me break down the latest earnings report for Microsoft, and then I'll give you my big picture stock review on the company. So as you can see, Microsoft just reported earnings this Wednesday after market close. And the results were strong. It came in at $70.07 billion of revenue, which beat expectations by 2.14%, and $3.46 in earnings per share, which beat expectations by 7.45%. And if we use the AI analyst over on dividenddata.com to summarize the latest quarter and earnings report, you can dive into the growth of Microsoft's real business and take a look at their outlook for the rest of the year. So as we can see, revenue was up 13% year over year. And since Microsoft's a global company, they deal with a lot of currency fluctuation. So assuming constant currency, that growth was 15% year over year. Operating income for the quarter was $32 billion, which is up 16% year over year and 19% constant currency. Net income was $25.8 billion, up 18% year over year and 19% constant currency. And as I mentioned, diluted earnings per share was $3.46. But the more context you need is that it's up 18% year over year. And the big story when we're analyzing Microsoft stock is around their cloud business. Microsoft cloud revenue now hit $42.4 billion, which was up 20% year over year. That's 22% constant currency. And as you can see, Microsoft's cloud business is now over 60% of their quarterly revenue. And it continues to grow at a high rate. And you might say, Zach, what is Microsoft Cloud? Well, that includes their infrastructure business like Microsoft Azure, but also their cloud-based software suite, whether it's Microsoft 365, Dynamics 365, all the way down to LinkedIn and GitHub. And it's this part of Microsoft's business that really is the core growth driver for the future. As you can see, Microsoft's cloud run rate for revenue is at $170 billion. And it's grown at a 5-year compound annual growth rate of over 26%. And to just give you an idea of how much this has grown, just back in 2018, that was not that long ago, Microsoft Cloud was only a $20 billion business. And now we're at $170 billion, and that's expected to continue growing. The largest chunk of this business segment is Microsoft Azure, which is a cloud computing platform. It's the number 2 competitor behind Amazon Web Services, but it does have a big gap ahead of Google Cloud. And here you can host virtual machines, databases, AI, which is the biggest growth driver. And you can think of this as infrastructure as a service, platform as a service, and software as a service. And to basically just give you a little bit more of a real world idea, if you want to build a web application like I did with dividenddata.com, you're going to be hosting quite a few things in the cloud, whether that's a database or your entire application. And if we take a look at the revenue growth for Microsoft Azure, it is 33% year over year or 35% in constant currency. And they don't every quarter give you revenue numbers with Microsoft Azure or their AI services, but a big chunk of this growth is coming from AI. And it's not just the training of models, it's every single time a chat is run on something like ChatGPT or even dividenddata.com. Those things are run in the cloud, often on Microsoft Azure. Their business is broken up into 3 segments: productivity and business processes, and then intelligent cloud, and more personal computing. And here I did another summary, and you can see that revenue growth grew by 10% year over year in productivity and business processes, 21% in intelligent cloud, and 6% in more personal computing. So yes, they did pretty good in the quarter, but that doesn't entirely explain why the stock is up 7% after hours. For that, it often has to do with comments about outlook for the rest of the year. On the earnings call, they gave outlook for Q4 fiscal year 2025, which is their next reporting quarter. They said they're seeing high growth in commercial bookings, The big piece of this, though, is that Microsoft Azure growth is expected to be 34 to 35% in Q4. So again, that is very strong guidance for the most important part of Microsoft's business in terms of investors. This is the number they are always looking at. And 34 to 35% growth for a business this large is actually nuts. The other most important thing Microsoft mentioned on their earnings call is about AI investment. With all these big tech companies, the question is whether they are going to continue spending more on AI infrastructure. And there has been some reports that Microsoft and Amazon are pausing some leases and slowing development, but they are still spending insane amounts of money. And Microsoft just gave guidance that they're expecting to grow capital expenditures again in fiscal year 2026, albeit at a lower rate of growth compared to fiscal year 2025. And hey, if you're wondering why that matters, Microsoft is now spending over $20 billion more a year in capital expenditures, just in the past year. And in the latest quarter just reported, Q3, they spent $16.75 billion. That's up from $10.9 billion last year. So yes, you see Microsoft's cash from operations in that time grew from $31.9 billion to $37 billion, but their free cash flow number actually slightly declined in that time because they're spending more money. So they're reinvesting in their own business and infrastructure. And from the perspective of an investor, that means they have slightly less money to pay you in dividends, share repurchases, or to acquire other businesses. But I'll get to that because Microsoft is still a high-quality dividend growth stock, and they're still raking in profits. As you can see here is the earnings per share for Microsoft compared to their stock price. And really since 2016, their earnings have been on an absolute tear. And what do you know, that correlates directly with the Microsoft Cloud business growing. Just in 2018, they were earning less than $1 per share in earnings. And in the latest quarter, they hit $3.46. And if you look at Microsoft's stock price in isolation without considering the earnings power of the business, you might say, they're overvalued. The stock's already gone up a bunch. But no, that stock price appreciation is backed up by earnings growth. And if Microsoft continues growing earnings at this rate into the future, then the stock price is bound to follow. For example, here you can see the future earnings estimates by Wall Street analysts, and they are projecting annual earnings per share growth well over 10% every year through 2029. If we take a look at some of their key financials, you can see that revenue per share has grown at a 5-year compound annual growth rate of 15%. Net income per share has grown at an 18% 5-year compound annual growth rate. And free cash flow per share, despite higher capital expenditures, has still grown at a 5-year compound annual growth rate of 14.86%. However, based on fiscal 2025, Q1 through Q3, it seems like they're going to underperform in fiscal 2025. But this is okay because the company is intelligently investing into a growth business. And as I just explained in the earnings results, they are already seeing the opportunities to continue investing. And Microsoft has a rock-solid balance sheet with $320 billion in shareholder equity. So their assets are well ahead of their liabilities. They also have $79.6 billion of cash and short-term investments. And even after making a huge $75 billion acquisition a couple years ago, they still have negative $19 billion of net debt. And that number continues to grow again. So the financial health of Microsoft is fantastic. And every year they just have tens of billions of dollars of reliable and growing revenue coming into Microsoft. And what this means for investors is that they have decided to pay a growing dividend. Microsoft pays a quarterly dividend that increases every single year, and the 10-year compound annual growth rate is 10.35%. Every year they have a 10% increase. And although the yield is small right now at 0.84%, they earn far more money than that, and the payout ratio is very sustainable under 30%. The free cash flow payout ratio is 29% as of fiscal 2024 and 24% based on net income. And this is always in a very sustainable range. The company also regularly buys back stock, although that has slowed in recent years as they are investing a lot of money into AI infrastructure. And frankly, I'm okay with that because they seem to be getting pretty good returns on their money. And after all, it's crucial for these big tech companies to be leaders in AI. So as I look at Microsoft, I see a business that will continue growing well into the future. And that growth will power increased payouts to me as a shareholder. It will also lead to continued high stock price appreciation. And as we go back to my portfolio, that's why I have Microsoft as one of my top dividend growth stocks. I think it's poised for a high total return, and I look forward to having this be a core position of mine for many years to come. Of course, that's just my opinion, and I'm sharing what I'm doing in my portfolio. and you should do your own research before making any investing decisions. If you found any of what I just said interesting, make sure to leave a like and subscribe to the channel for future stock analysis content. And if you want to use the stock research tool I showed throughout, all of this is available at dividenddata.com. The link is in the description and pinned comment of the video. With that said, thanks for watching, and I'll see you in the next one.